Welcome, everyone. My name is Phoebe Tucker. I'm a Senior Nature Associate at the Green Finance Institute. And for those of you that don't know about the GFI, we're an independent advisor to governments, and we're focused on how finance can be used to facilitate a real economy transition. We're here today to discuss the business case for UK corporates engaging with voluntary carbon markets now, especially for those that are not currently offsetting but view it as a vital part of their future decarbonisation strategy. We're hosting this webinar because in our work with corporates, financial institutions, and governments, we've noticed that there's a real disconnect between the supply and demand side of the voluntary carbon market and the fact that suppliers need to think about their future demand signals now in order to meet that future decarbonisation need. And so, partnered with Arup and Nature Broking, who have joined me here today, we've decided to offer this webinar to UK corporates. It's going to focus on how early, well-governed engagement can help manage cost exposure, preserve strategic optionality, and support credible claims around climate in a rapidly evolving market. This webinar also forms part of the GFI's work to better understand UK corporate demand for UK nature-based carbon credits, because DEFRA, the UK government, has commissioned us to seek out corporate perspectives, amplify them at different stages of market engagement in order to inform their policy discussions on the future of UK carbon markets. And we're going to circulate a linked survey to attendees after this call. So I'm delighted to be joined today by Luke Baldwin, who's CEO of Nature Broking, and Stephen Thompson, who is Associate and Lead of Arup's Offsetting Consultancy Services. They've kindly agreed to join me here today to offer their insight on why corporates should be thinking about this, what is the business case, and how they can act on this. And this will be followed by a presentation from GFI from our perspective on the policy and market outlook. Now, we've allotted time at the end for Q&A, but we really welcome everyone to add their questions and their comments in the chat and the Q&A function as we go. So please feel free to do that. And towards the end of the Q&A section, we'll also allow for people to raise their hands, come off mute, and hopefully we'll have a productive and fruitful conversation. So with that, I am first handing over to Luke Baldwin on the business case for why corporates should be thinking about this now. Luke, over to you.
Brilliant. Thank you very much. And thank you very much for having. I'm going to be answering the question of why carbon crediting is a now decision, why acting early can help you manage cost, risk, and credibility. So if we go to the next slide. Nature Broking is a carbon credit intermediary and advisory company focusing on helping corporations access the carbon market in a way that makes sense for them as an organization. But to set the scene, when we look back, when we look back through the carbon markets, we look back at what were the drivers and the benefits of accessing the carbon market pre-2023. Now, the carbon market is a very effective way of pushing climate finance towards really, really good outcomes. But there's been some issues, some structural issues with the carbon market in the past. So pre-2023, there was a real move towards organizations becoming carbon neutral. So being carbon neutral meant offsetting or mitigating the emissions you pushed into the atmosphere through the purchase of credits. That was a UN-backed program. Back in 2020, and all organizations were driven towards was purchasing credits. The idea was that you would mitigate your impacts, but this was done perhaps because of driving a competitive advantage and employee satisfaction and talent acquisition. Ultimately, it ended up being a bit of a marketing tool, in my opinion. What we were looking at here was that people would purchase these credits annually, but it was done as the smallest possible budget, because to be carbon neutral was to be carbon neutral. Ultimately, you got the certificate at the end, whether you were spending £100 a tonne or whether you were spending £3 a tonne. So if we go to the next slide. And then a huge amount of risk and exposés came out. So many will have seen in 2023, there was a large push. There's some exposés done by The Guardian and by The New Yorker that talked about projects, talked about some of the issues, whether they were actually having impact or not. And this led to a sort of massive move away from utilizing carbon credits at scale. But if we go to the next slide, suddenly there was an increased reputational risk about accessing the carbon markets. Low cost was no longer an option. So this couldn't be done on a shoestring budget. It was less impactful for business, and so therefore it was deemed to be too high risk. And at that point, most people stopped accessing the carbon market. But what it did lead to, if we go to the next slide, was a huge amount of improvements across the market. So something called the Integrity Council for the Voluntary Carbon Market launched, which increased the integrity of projects. So it meant that more projects were going through a more rigorous assessment framework to ensure that it was having the impact that it was having. It increased the professionalization in the market. So rather than just people buying credits, purchasing them to simply offset, they were suddenly looking for better, more accurate, more due diligence solutions, and this drove and improved market infrastructure. Next slide. So, setting the scene of where we are now, every company to reach net zero will be required to use carbon credits. The net of net zero is carbon removals. And in order to access the carbon markets and to do it in a way in advance of a commitment, we have to build a credible business case. So, if we go to the next slide. So we must build a compelling business case, which is what I'm here to talk about now. Next slide. So what we've come up with is our sort of three-step process. The first is start with the CFO. So this is data from Allied Offsets, which are a carbon credit, pricing and information and data source. And they're predicting that even in a low demand scenario, the prices for nature-based removals is going up at around sort of somewhere around $20 a ton now, likely to go up to around $50 by 2050. But you can see the increase coming at the point between 2035 and 2040, that more striking increase. If we look at the medium and the high demand scenarios, we can see those prices going up significantly. So what we're seeing organizations like Microsoft to start purchasing credits now, locking into those longer term offtakes to hedge against that future price risk. Now, if we look at some of the data, what else is on here? We look at the 3 to 10 times lack of supply predicted by McKinsey when it comes to credible carbon removals, which has led to a massive increase in the number of offtakes. So when we're talking about starting with the CFO, we're talking about, okay, are you going to have to be net zero? Is there enough of policy push for you to be net zero? And if there is, you are going to have to engage with the carbon market at some point in that net zero journey. Starting now gives you an advantage or a competitive advantage because it can lead to cost savings essentially by starting now compared to the future. So getting your strategy right is really important, but there is a financial benefit that comes from starting now rather than waiting for the future. Next slide. But if you are buying forward, you have to de-risk it. So if you're buying forward and you end up buying the wrong pop credits or credits that then don't deliver, then you end up with a really poor situation where you've spent money on something that doesn't necessarily make sense, and you're left with in inverted commas, a stranded asset. So the key things here are, one is ensure that you're working with the highest quality projects with the lowest risk. So what we mean by that is very, very well-governed projects, high quality projects that have a low risk tolerance. And it's where things like working within the UK, as an example, is a really good area to work with because it's got a really good legal framework and it's got a really good system in place to be able to ensure that you've got the really high quality projects. But that doesn't necessarily mean that you just have to stick with the UK. Building a diversified portfolio approach is critical. So there will be multiple different projects. Some will fail. Let's not lose sight of that, the best quality project. So having that portfolio is a good way of mitigating some of the risks that you then have. But the key thing is having insurance that sits over the top of this. So if you are buying forward of an obligation, as we are talking about here, then buying forward of that obligation, insuring that portfolio, ensuring that risk means that you are then protected, or the capital that you're putting into projects is then protected and you get the credits that you need. So making sure that you look for the best quality projects done in a portfolio approach where it's insured helps to de-risk it. So if we now go to our narrative to board, you're now saying, right, we now need to hedge against future price rises. So we're making a saving compared to what we can be making in the future. We've got really high quality projects, which mitigate some of the reputational risk. We're ensuring this. So our investment that we're making into these projects is relatively low. Is protected. So we know that we're either going to get the credits back or we're going to get the insurance is going to pay out a claim in the case that we end up with a loss. And we're mitigating it, and we're working with multiple different projects with multiple different carbon removal types or carbon credit mites backed. So next slide. But the final thing is, how do we create organizational value? So when we come to this, what we look at when we look at carbon credits is we say most carbon credits are straight, when you purchase them, are put straight on the profit and loss sheet. So when you're speaking to your CFO, when you put it onto the profit and loss sheet, you're immediately affecting the profitability of an organization. So how can we turn this investment, this forward investment into an asset. And that's where we're looking at how do we create value for an organization. So if you're thinking about this in terms of value, if you're purchasing something that has real intrinsic value in advance and of an obligation, then that should be capitalized as an asset on your balance sheet. So in conclusion, you're suddenly then going, well, actually, first step, we're starting off from the point of view of the CFO, where we're looking at projects and we're saying, look, we can make a saving here, so we can access the market, make a saving, and you can showcase that by hedging against future price risk. We've de-risked it, so we're protected against the investment that we're making and the projects that we're working with, and we're creating value for the organization. So these three things create an incredibly compelling business case to be able to take the board to go, having action now is not just about taking action and climate action. It's about creating real, tangible value for our organization alongside helping to decarbonize the world and the planet and to invest in really amazing projects. So I will probably stop there. I don't think there's any more slides. So really appreciate the opportunity to speak, and any questions on how our three-step process works, please let us know.
Fantastic, Luke. That was brilliant. I love that three-step process, and we're already getting questions in, so looking forward to addressing those in the Q&A later. So now we'll move to Stephen, who's going to build on what Luke has just presented and show the more of the how side of offsetting strategy and what good looks like. Stephen, over to you.
So thank you so much, Phoebe, for inviting me to talk today. And thank you so much, Luke, for that first part as well. So it's great to be able to talk to you a little bit about how we can do this. So would you mind rolling on, please, the next slide? So why carbon credits have become a how question? I think I'm always deliberately optimistic in this space. I think it's important to try to stay positive. I think we recognize now that corporate decarbonisation expectations are tightening. We understand the wider picture now when it comes to decarbonisation. And I think residual emissions and how we address those are becoming under increased scrutiny, as Luke has suggested with the various different articles that are now being shared. And so the question, I think, is no longer whether to engage with the credits, but how do we do so credibly? So next slide, please. So the challenge, I think, is structural, not just technical. And I think if we were to show my little illustration on the right-hand side there, I think we're juggling an enormous amount of different pressures and different challenges, and we're on a unicycle. There's lots of things that are happening and pushing us in different directions. And I think when we look at the carbon markets themselves, the standards are rapidly evolving, guidance is changing, and policy signals. And this is a pretty high stakes position for most organizations who are looking to purchase carbon credits. There's exposure, there's reputational risk. And I also think that greenhouse gas removals, which throughout my slides, I apologize, I refer to as GGR, adds complexity. There's a question about time, there's a question about liability. These are all kind of things that kind of initially, when we're thinking about juggling all of these processes that we also have to play around with, isn't exactly the most straightforward thing in the world. So next slide, please. And I think Luke has made an excellent point here that delay when it comes to our future procurement of greenhouse gas removals is delaying risk. It increases your risk, I should say. And I noticed on the call today, we have lots of fabulous organizations who are creating great projects in the United Kingdom. And I think there's probably an element of competition about you trying to find the right buyers. And I think it's the vice versa as well, with those buyers also trying to find the right types of projects that meet their future needs as an organization. So there's kind of in this weird way, this competitive side between both buyers and suppliers. And I think we have, when we talk about nature-based credits, particularly in the United Kingdom, we have long lead times from projects being started today to actually returning a credible greenhouse gas removal in the future. Next slide, please. But just because it's hard doesn't mean it's impossible. I think there are lots of good signs here in the market where, as Luke has alluded to, that the standards are starting to align. We're starting to understand the difference between avoidance, reduction, and removal credits. Governance frameworks are improving. I think what happened back in 2023 kickstart the market to make sure that we had something a little bit more credible. And I think most importantly, there are lots of organizations who are started and are doing this. And I think one of the roles, which I think is really exciting about the GFI's piece of work, is that those who are buying in the market, we should be sharing our experiences a little bit more with others to show, hey, we did this, didn't go great, or this went really well. And I think we need to start learning a little bit collectively together and to start to share those stories and that narrative. Next slide, please. But I often get asked what good looks like in practice. And I think this is a very difficult question to answer in a broad terms. I think it's very specific to each individual organization. I am going to stress here that greenhouse gas removals, in my perspective, sits very much in alignment with a wider decarbonisation strategy. You can't just focus on greenhouse gas removals alone. You need to be thinking about how you're decarbonising. Exactly how, when you're thinking about decarbonising, you need to be thinking about your greenhouse gas removal strategy. And that's always the thing that I think sits consistent across. I think the challenge around preference for high durability is important, but when we talk about nature and the wider benefits, I think there are some wider impacts that needs to be considered and supported. When we talk about biodiversity improvement, we talk about flood attenuation, water quality, there are some really wider benefits here that just extend beyond permanence, which again, I think is important when an organization is considering nature. And then one thing that I'm always shocked at is organizations say, hey, we've bought this wonderful thing and therefore we're now net zero X, or we're now great. And they have such tremendously ambitious claims. And often once you scratch below the surface, that probably wasn't as accurate as they intended to do. So I think what good looks like is about being conservative and being transparent with what you have done. And then finally, being explicit about the treatment of uncertainty. You know, when we think about these projects, we talk about future offtakes, what are the risks? Again, it's about sharing that information and talking about that freely. Next slide, please. So I spend a lot of my time working with, and I work as part of a wonderful team back in Arup, where we work with organizations who are looking to set their strategies and take that through to procurement when it comes to greenhouse gas removals. And from some of the things that we've learned, the key thing here is define what you're planning to do. What is the claim you're looking to meet? What is the framework? How are you going to then share that within your organization to drive change? Make sure that you understand what quality looks like for your organization, understand the risks, and make that very much upfront at the start. And then if you are taking risk, how are you going to keep it, or are you going to transfer it? Are you going to be relying on insurance, or are you going to be doing it yourselves? There are plenty of different routes and markets for how you can choose to do that. Again, it's dependent on your own organization. But the key thing here I'm going to stress here is don't try and do everything at once. Small steps. No organization is suddenly going to say, hey, I'm going to offset scope 1, 2, 3 next year, ta-da. That's just not practical for large organizations. Think about small steps, build that capability and build that the feeling of that you understand what you're doing in small steps that continue to grow. And I think that's a very important, I think that's the most important really. Next slide, please. I think in the past, when people have been purchasing offsets, I think greenhouse gas removals is different, particularly when we talk about nature. Nature projects, particularly in the UK, are going to take time. And I think it's recognizing that at the very start, something that you might be looking to buy today might actually come to sequester something in 20 or 30 years' time. So I think there's a difference in that mindset and that process. Permanence and reversal management matter. When we talk about UK greenhouse gas removals, when it comes to nature-based, how are those greenhouse gas credits going to actually appear in the future? What protections are going to be installed? These are questions that we should start to ask our suppliers of these credits to make sure that these are genuinely going to still be there in 30 years or 40, and then hopefully a lot longer time. These are new contracts. I noticed on the call that we have lots of solicitors who have joined us today. That's unsurprising. I think this is a market that is continuing to grow, where we are needing good, sensible contracts and good advice in this space. And again, this is different to an individual spot purchase, which may have had in the past. These are things that we're looking forward to. And so therefore, there's an element of sensible contractual wording that is required. And then again, it's monitoring and verifying over time, making sure that when you're working with your suppliers of those carbon credits, that they're giving you the information to give you confidence that these projects are actually continuing to move forward and continuing to happen, so that you get your, as Luke's described it, your asset becomes real in the future. Next slide, please. One thing that we have started to see is this introduction of buyers clubs. The large tech companies have already kind of done their own little thing when it comes to this, but they're putting enormous volumes of money into some of these projects. For most of us organizations, we don't meet that threshold when it comes to joining some of those buyers clubs. So how can we work a little bit differently and work together to kind of show to kind of deliver bigger impact? Is something that Arup, we have spent a lot of time thinking about, is that how can we aggregate demand to support early stage projects? There are obviously some clear benefits of this. Share due diligence with others, and you can share learnings as well. But ultimately, it means that you have effectively a larger buying capability as a collective, rather than just being as an individual. But I think one thing that we have spent a lot of time with is this is not a silver bullet. Governance still matters. How you shape that, how you work with other organizations to form your buyers club is very important. And that structure is the essential thing that allows you to be able to work together. And setting that out right from the start is the most important thing. Roll on again, please, Phoebe. So I'm going to leave this a little bit here with what organizations should be asking now. Just to kind of summarize, what residual emissions are truly unavoidable? Do we think that we could actually be decarbonising further? If we think that, we probably should be doing that. But then how do we then think about what those residual emissions are going to be and how do we address those in the future? What risks is an organisation prepared to carry and how do we protect our climate credibility? At the moment, lots of the standards are pretty low when it comes to the claims that you're looking to make. I don't think that's going to stay the same for much longer. And so we're going to have greater expectations about what an organisation is going to claim when it is, say, net zero. And are you ready for those better standards, shall I say, than what we have currently? And where do you need flexibility versus certainty? Do you know that you need to be doing this now, or do you need to be doing little bits and incremental steps? Do you want to stay flexible, or do you want some certainty? And I think that's important to be considering. And my final slide is that I think this is really a governance challenge within an organization. If you get the right governance inside your organization and you get the right buy-in, as Lucas said, you get the right people at the right time talking about this, it can be really exciting. We've seen some fantastic benefits inside our own organization where we have been quite open and transparent with the way that we have done Arup's own procurement process. And we're starting to see others in our teams starting to engage with that and see the projects that we've invested in and see that joy. So building that narrative within the organization is really important. Delay narrows choice, I think, is a very fair thing. At the moment, as you can see, there are plenty of organizations who are making off-takes now, which means that if you are relying on buying something in the future, the market's going to potentially be a little bit more constrained than it is now. And I guess this is something that I think a lot of us would probably echo, is that we want to be credible over time. We're not looking for perfect projects today. And I think organizations who are doing good things are nervous. I think there's a little bit about green hushing going on at the moment. And I think we should be a little bit louder. And I think we should say when we have done good things, not claiming to be perfect, but at least sharing the stories and the narratives of what we've been up to. And that's all for me.
Brilliant. Thank you, Stephen. That's an excellent closing thought to end on for your segment, because I think lots of people have experienced that dynamic where you get the right buyer and all of a sudden things are really exciting, but only if the conditions are right within that organization. So fantastic. We'll now move on to the market and policy outlook that I'm going to be delivering. So for context, within GFI, we have a nature-based and an engineered CDR removals team. We are in the mix with governments, different market coalitions, buyers, sellers. And so we've pulled this presentation together very quickly to offer some insight from more of a macro perspective compared to what Stephen and Luke have kindly presented on. So next slide, please, Elwaz. Fantastic. So starting with the market outlook, I think it's a really interesting time. There's so much information flowing out from all different sources. And so we're offering these sort of high-level statements to really categorize or characterize the demand landscape in terms of both current and future demand. So Recently, there's been a discussion on how active the carbon market is because retirements are pretty flat, depending on which data provider you look at. But if you look at forward demand or potential or signs of forward demand, SBTI commitments and other frameworks for goal setting for corporates, they're on the up. So commitments surged 227% in 2025. And there's a lot of talk right now about how SBTI allows for carbon credits within wider decarbonisation plans. So really looking at current market activity is a bit of a red herring, not completely, but really people should be looking at forward demand signals such as net zero commitments. Another thing we're seeing is that the market is definitely going to be shifting from avoidance. It's predominantly avoidance-based credits right now, but really there's a lot of market sentiment coming out on how we should be better supporting removals, such as woodland carbon and engineered CDR. And demand for those removals is expected to grow a lot between 2030 and 2040. So as people start hitting their net zero targets, we think that the removals credit supply and transactions will surge upwards. But within this sort of removals conversation, there is also this discussion or this debate about the balance between nature-based and engineered removals. Sometimes you'll hear these referred to as short-lived versus long-lived, which in of itself is a debate between certain market stakeholders. But really, we are looking at a balance between the two. I don't think anyone is expecting to fully offset within their carbon credit portfolio to fully offset with one or the other. I think as Luke and Stephen have said, it's a mixed portfolio approach, but we are going to see constrained supply of the higher quality credits on both sides. So there's been a lot of market speculation on what makes for higher quality and what prices are needed to achieve that. And I think we even have a question in the chat in the Q&A on the topic of pricing. But really it is we're going to see the market sort of bifurcate between higher and lower quality, or what the market deems higher and lower quality. So that's another reason why corporates really should be thinking about this now to secure what they believe is higher quality carbon credit supply. This has been mentioned before, but offtake agreements are definitely growing in volume. So spot purchases where a corporate might come to the market and buy credits that are ready to be used for offsetting within that year. That's still very much active, but we've seen a huge growth in offtake agreements in volume. I think we've seen that there's been a 6 times growth for removals between 2023 and 2025. So corporates are starting to understand the incentive or the business case for signing those forward-looking agreements. But if we get into those numbers deeper down, they are currently dominated by what we call anchor buyers. So, for example, the Microsofts, the energy companies of the world, those that have the capacity to sign those forward-looking agreements, they're the ones doing it the most, not the smaller organizations and the corporations that we would love to see enter the market. I've mentioned before about the bifurcation of carbon markets, but I'd want to flag here that it's not just about high quality and low quality. It's about different standards, it's about different industries, different policies, depending on where you are geographically. I don't think there's any way we can get around the fact that the carbon market is always going to have some degree of complexity, and one corporate's carbon crediting strategy or decarbonisation strategy will look different depending on where they are. And I think we all as an industry need to accept that to a degree. And on that topic, we are seeing, as a company, we are seeing more and more talk about compliance-based markets. So really, we're here to talk about voluntary carbon markets, but we are not going to be able to get away from the fact that compliance-driven markets, such as the emissions trading schemes within the UK and the EU, they are going to have an impact on the voluntary market as well. So, for example, the ETS, the UK's ETS is debating inclusion of certain carbon credits within that scheme. And corporates who are just looking to buy on a voluntary basis should be thinking, okay, if that goes ahead, what are we going to expect in terms of our supply of credits? And should we be acting now on certain types of credits to secure our supply? So really, in summary of that, we think that corporates or successful corporates are going to be moving from a kind of buy carbon mentality to managing their carbon risk, locking in long-term supply, managing those segmented strategies, and really treating carbon as a core input to business planning rather than a discretionary offset. So next slide, please. So that's on the market outlook, but just to touch on the policy outlook, because as I mentioned, GFI works with several governments and we do like to keep our finger on the pulse about what are the big components that are moving around this space that could have an impact. So when thinking about this with the engineered CDR team at GFI also, we identified really three big buckets of activity right now, if you think about what's happening and what people are talking about within the industry. The first would be that standards are developing at an accelerated rate. And I think that a lot of people on this call will identify with the feeling that last year in particular, there were so many standards consultations out and government consultations, and a lot of feedback was being pulled in from the market. So, for example, SBTI is a very popular standard for target setting within corporates. It's probably the predominant standard setting framework out there. I think there's around 700 companies within the UK that have declared net zero targets via SBTI. But they've just released their version 2 of their net zero standard that has basically revealed that they are supportive of using carbon credits within their strategies from 2035. And there's a really interesting dynamic with how they dictate the balance between nature-based carbon and engineered carbon within that. It's almost a glide path where they want to incentivize companies that do want to use carbon credits to first use nature-based carbon and move upwards to engineered carbon as the supply of that increases over time. We've also seen this year that the GHG's protocol on land sector removal standard has been released. That has been long awaited, and that's really all about capturing land-based emissions and how to account and manage for that. That's significant here because that has been seen by many as a precursor to insetting, not the only component needed, certainly, but a very important step forward. And when we talk to corporates, they often talk about this balance between offsetting and insetting. So, for example, food and beverage companies have a preference for insetting within their supply chains. And governments are really curious about how they can facilitate this as well. So the UK government, for example, is exploring insetting. It was a major theme within the farm profitability review. And so this announcement has come at a really timely point in the market for those discussions to continue. Other standards include the ISO's net zero standard, which I believe is due for publication later this year, and the BSI's nature investment standards, which is all about streamlining the procurement and due diligence checks within both nature-based carbon and other types of nature markets. This has been touched on previously by Stephen, but we are also seeing public procurement and buyers clubs start to emerge, particularly buyers clubs that are incentivized or ran by governments. So Canada's recently announced a 100 million advanced carbon removal coalition. We've got the European Union CRCF Buyers Club, which is a lot around engineered CDR and biochar. And England, DEFRA announced late last year that they are exploring a woodland carbon purchase fund, which could be launched as soon as autumn 2027, where essentially they're buying up ex-ante credits and they're waiting for them to mature before either selling them to the market or using them for the government's own offsetting strategy. And then finally, we have a lot of consultations and key decisions due from government. So last year we had the voluntary carbon and nature markets consultation. This talked about a lot of things, including stacking and approval of ICVCM CCP principles. We have the call for evidence, which I believe is the response is due this month. Could be a bit later. And we have the technical consultation on the integration of carbon credits within ETS, the UK's emissions trading scheme. So that point I made earlier around compliance markets and how the supply is balanced, that is going to be a key outcome. And many people think that that will inspire a lot more supply to come to the market, but others are skeptical. So we'd love to hear your thoughts in the chat. And then finally, consultation that DESNZ ran last year on the net zero transition plans. This is really key also. I think Stephen put it beautifully. How corporates claim and disclose their carbon credit usage within their strategies is going to be much more streamlined, hopefully give people a lot more confidence within those organizations to make those claims and to know what they've got to disclose. And that is going to have a knock-on effect to the voluntary carbon market, as we hope more corporates will feel comfortable with what they can claim and what their disclosures shall be. So that's just a whistle-stop tour of the policy outlook, but would love to hear your thoughts in the chat about what we've missed. We've got conversations ongoing about Article 6.4 methodologies, inclusion of carbon removals within the UK's sustainable aviation fuel mandate, which are all kind of bubbling away in policy discussions right now. But we would love to hear your thoughts in the Q&A and in the chat. So please feel free to say anything that you think is really going to make an impact in this space going forward. Next slide, please. And finally, I'll just finish on really the origin for this webinar, which is our research program that we're running around demand for UK nature-based carbon. So as mentioned before, we decided to host this webinar as a way to connect with corporates and to really clarify the business case. But really, we are running a behind-the-scenes research program that's basically centered on the question of if future demand from UK corporates is so high, then why are UK nature-based projects struggling to secure interest now? So we were commissioned by DEFRA to look at this question amongst the policy consultation documents that were circulating last year. Essentially, we suspect that there is a real breakdown of future demand signals. So UK corporates that wish to use nature-based carbon from the UK in their decarbonisation strategies, they may be expecting that, but UK suppliers are really concerned that that's not going to happen. And so they're not acting right now to create that supply over the long term. So what can we do about it? We're hoping to really capture the corporate perspective on this. We have an anonymised survey that will circulate after this webinar, but we really encourage corporates to come to us and with their thoughts and their experiences so that we can capture that and report back to government around the solutions and barriers that would really help unlock these future demand signals and make it clear to suppliers that whatever size demand ends up coming through, there will be supply to service that within corporates' wider portfolios. So our emails are at the bottom and we'll post them in the chat for ease, but really wanted to make this point to everyone in the audience because I think we all want to see a healthy, robust UK nature-based carbon market within the wider global voluntary carbon market. So that is all. If I'll ask to stop sharing, we'll move to Q&A now. And I notice we've got quite a lot of questions in the chat. We can go, I'm just looking at them now. It's great questions. I'm going to start actually with Nicola's question, and I think this is for you, Luke. How does insurance help, though, if the project fails? Because doesn't the company just get a payout but not meet net zero?
So it really depends on what policy you've got in place. The insurance, by and large, pays out either in capital terms, i.e. pay you back for the credits that you've got, or pays out in credits. So you can get your credits that you need on as far as you can get like for like basis. So in terms of meeting your net zero, obviously you've, as Stephen very much put very clearly and rightly, which was you have to decarbonize first. This is just for anything that is totally unavoidable. And so the insurance policies that are in place either pay out in cash terms to provide you the cash to reinvest, purchase credits, or by providing credits, so depending on the insurance policy you have.
Very interesting. And do you see more insurance? I'm just going to ask my own question now. Do you see more insurance for the buy side coming through the market in terms of developing products and services?
I know Stephen's typing, so I might hand. Oh, you're not okay. I thought it was saying in the question and answer. No, I think definitely. I think when you're looking at the London insurance market, we're seeing more insurance companies and insurance brokers in particular developing more interesting products. There's Gaia Secura, which is an insurance intermediary. They are working on creating products that first both align to the buyer's need, which is I need my credits in order for me to claim net zero and therefore provide me with an insurance policy that protects that. But then also looking at the projects as well. So, what happens if the buyer drops out? So non-payment insurance, buffer insurance, which is another thing that's been looking at. So there is a much more increased and wider set of products and policies out there, or wordings that are going into the insurance of carbon credits and nature-based carbon credits, which align more to buyers' need, but also project needs as well.
Brilliant. That's really reassuring to hear. Next question, I think, we'll take Helen's question on the incentive for businesses to invest in high integrity carbon credits or projects if the carbon price is the same as for low integrity credits. How do you make the argument to CFOs? Um, Stephen, do you want to take that one? Or Luke or Stephen, both of you could probably offer a
I,
perspective.
I'll have a first starting point. I think if the price is the same, I think you'd always want to go for the higher quality one, mainly because of the reduce of the risks associated with that project. To mean it actually supports a credible claim that you're likely to make. I think that the more often than not, and I hate this word quality because I think quality is dependent on the types of organizations. But effectively, if a project is more aligned to your company's values, what you're trying to make is the claim that you're looking to make, what you're looking to aspire to do with it, if that project is more expensive than one that is cheaper, I think that's a decision that you need to make within your own organization to say, how does that work with our own values and what we're trying to establish and accomplish as a business? And I think that's where you can then start to tie it back to company strategy, company purpose, and therefore, if you're thinking of, you might decide to, for example, buy a smaller number of a particular projects that align with those values rather than a larger volume of projects that don't align with that. And I think that becomes a decision that you need to make in it as an organization. But there's plenty of conversations which are happening probably right now on this exact topic about what is right and what is not right for our business. I think you need to shape it to make sure that it is right for your business and the claim that you're looking to make.
Yeah, I think just to echo that, that's making sure that it aligns to your business strategy and also being cognizant of risk. I think Stephen again very clearly brought it up. Lower cost credits doesn't necessarily mean that they're higher risk, but there is a correlation there, and so therefore being aware of that, the impact that you want to have, and the costing associated with that is really important. So it's how much reputational risk your organization wants to put on. When it comes to making the argument for the CFO, this is where I think the accounting treatment is really, really important, because if you're creating value for an organization, i.e. purchasing a credit that you add to your balance sheet that has value, then the cost of it actually becomes higher. So, sorry, the value of it becomes higher with the cost until the point that you write that off onto your balance sheet, onto your P&L at the point of use. So, without getting too noddy and into this, the accounting treatment is really important because it allows you to build that business case. So, for example, I didn't actually bring up the slide, but we've worked with Clyde & Co, and Clyde & Co have worked out that they can create they have done this. They've created an asset on their balance sheet that is their carbon removal procurement forward of their obligation for their net zero date. And that then creates the CFO. And the way that they got that past board was saying to the CFO, well, this thing has value. This has an actual intrinsic value. And therefore, if I'm spending £100 a ton and I'm not utilizing it until the point that I utilize that, that should have £100 of value, just the same as gold, just the same as a stock or a share. And that's when I think the conversation transitions from, being very focused on, okay, well, how do we align it to strategy? And then takes it just to that next level of, okay, well, how can I create value for the organization and see it in terms of P&L terms?
Brilliant. I'm glad you included the accounting treatment in your presentation. It's really interesting, and we can share links after around that particular case study. But also, I wanted to flag if anyone wants to raise their hand and come off mute and have pose your question or a comment on any particular topic within this, and please feel free to do so, and we'll prioritize your question or comment. But back to the Q&A, I think this is a good question to Stephen. The Woodland Carbon Code, I think, was launched in 2011, and just about 4,000 units have been retired up to now. Why is this?
It's a fab question. Effectively, I think that number is a little bit higher now, but the challenge has been around nature takes time to grow. It's slow. Effectively, we see the best curves appearing. The largest acceleration of carbon stock increases year on year between year 10 and year 20, depending on the type of planting and the type of solution that that site has decided to employ. Arup recently, we've had this, some can see people on the call here, some wonderful partners with Nattergal and Wilder Carbon, where we've made a commitment where we've purchased a credit, and that might not appear for 30 years. And that is an acceptance that we've made. And that profile is based on credits being given back to us over 5, 10, 20, and then 30 years' time. And that's appropriate because that's how long nature takes to grow. And we need to make sure that that is genuinely something that has happened on site. So we need to go out onto site, measure it, report it, and then verify that, and so that we can then credibly claim that that has actually occurred and that removal has happened. And I think it's very important to note, and I think this is one of the issues when it comes to nature-based solutions in the United Kingdom, is the time it takes for these projects to start. And I think it's really exciting to hear how Phoebe and the team at GFI are going to answer this question, which is how can we start to incentivize these projects accelerating a little bit earlier?
Yeah, exactly. Just to build on that, it's exactly why the UK is a little bit disadvantaged compared to international markets because when we plant trees, for example, they grow a little bit slower than, say, trees in tropical climates or around the world. And so you are looking at the carbon units being converted to ex post units. I think it starts hitting critical mass or starts hitting significant returns from year 20, I'd say. Some people say even later, but really you have to plant them and then wait 20 years, and then you have those usable carbon credits. And so that's why there's this coordination challenge in the market right now, particularly for the UK and other northern climates. So just a couple of technical points, actually. Nicola asks, what are offtake agreements? Apologies, we should have probably clarified that, but either one of you could take that question.
Yeah, I mean, an offtake agreement is an agreement to purchase credits in advance of their delivery date. So an example might be, I'm working with a woodland project. I'm going to enter into an agreement. The agreement normally forms a part pre-purchase where you almost pay a deposit for the credits to be delivered, and then you normally pay on delivery. So an offtake is in essence where you say, I'm going to buy these credits. They're not going to be delivered until 2033, but when they do get delivered, I'll pay my balance. And it gives something for the projects, obviously, to look forward to deliver because they've got certainty of demand, so they get project capital through the door. There's also a lump sum that normally gets paid up front as well, and it's a good way of essentially locking in today's prices, so reducing that uncertainty that we've been talking about, but at the same time keeping flexible and not putting too much capital allocation to a project in advance of their delivery date. So it's a risk management mechanism.
Brilliant. Thank you, Luke. And on that, I'm just going to follow up with another terminology question. What is the difference between the Woodland Carbon Guarantee and the England's Woodland Carbon Purchase Fund? That's a good question. So essentially, the Woodland Carbon Guarantee was the government saying to nature-based projects that we will offer you a guaranteed price once your units are verified, and we can act as the buyer of last resort. In case you can't secure any better deal in the market, you have this sort of floor price that you can reach or hit in case other demand doesn't materialize. Whereas England's Woodland Carbon Purchase Fund works a little differently. It's the UK government saying, we're going to purchase some of your ex-ante or your PIUs right up front as soon as they're kind of ready to be sold as PIUs. And we'll wait for them when they're in our possession to turn into WCUs, woodland carbon units, exposed units. So same sort of principle of supporting revenue, but different in terms of when that money hits and under what conditions. So I hope that's helpful. Moving on then, I think this is a good question. What are the truly credible alternatives to SBTI, as it always comes back to science-based targets to give credibility? So to both of you, really, what kind of alternate frameworks and organizations are you seeing corporates are adopting?
Do you want me to have a crack at that, Stephen, first?
Please.
So I think Phoebe brought it up. The ISO corporate net zero standard, I think, will be really interesting when that comes out, because that will give another kind of separate organization backed by the ISO. There's also the BSI. So the BSI is leading on its Flex 702 or Flex 700 series, which is around giving credibility to projects. But I suspect on the other side, there will be a BSI corporate net zero standard coming out, whether that aligns to the ISO. And maybe Phoebe, you know more about this than me. The other part is then the VCMI, which is another one of the acronym soup, but nevertheless, VCMI, which is the Validated Carbon Markets Initiative. I don't know, I can't remember, my dyslexia gets involved here, which is looking at how to credibly make contribution claims. And they have a bronze, silver, gold and platinum tier on how much you mitigate, what pricing you'll put into that, and they verify the claims that are being made. So it's multifaceted. There's lots that are emerging, but I think what I'm really interested in is, and if there's anyone from government here, is how government might be ending up endorsing certain net zero standards for corporates.
And I think there was a lot of discussion on that in the voluntary carbon and nature markets consultation. Stephen, do you have anything to add to that?
I do, and I guess it's more of a challenge, which is science and the science in terms of if we follow the IPCC guidelines and their roadmaps to net zero and to tackling climate change effectively shows significant greenhouse gas removal capability being scaled year on year. I think the SBTI challenge has been that they have waited until a particular year, and at which point then you suddenly become net zero by making your purchases. And the change that SBTI are looking to do is that it starts to align more with the science, which is saying that we need to scale up our greenhouse gas removal capability. So I think if an organization is looking to genuinely want to follow the science, they need to be scaling their greenhouse gas removal purchases alongside their decarbonisation activities. And that is effectively how we're going to tackle climate change. So yes, there might be variations of different frameworks that say it, but if there's an organization that wants to be science-led, that is the pathway that has been set out for us.
Yeah, really good challenge, Stephen. Thank you for that. Next question. This is lovely. As a graduate in an organization, how would you recommend pushing those higher up to act on carbon offsetting through the use of carbon credits?
Ask the question. Do it. Go for it. I think depending on your organization, but I think it's so important for you to start to raise the question and ask. One of my favorite challenges within organizations is, so you have a net zero strategy. Can you please show me your greenhouse gas removal strategy? And if an organization only has a decarbonisation strategy, then you can say, hang on a minute, you're not net zero. And I think it's a really fun test to understand how serious an organization is around net zero to see whether or not they have a greenhouse gas removal strategy yet. So maybe it's a friendly nudge to say, can I see your greenhouse gas removal strategy? And if they've got one, great. And then say, what are you doing about it? And I think I think everyone on this call would empower you to do exactly that within your organization.
Yeah, brilliant. Luke, do you have anything to add to that?
No, I very much echo what Stephen says, like shake the tree. I think, what we're seeing is that a lot of the reasons why people are engaging with sustainability is a talent acquisition. Like, blunt is a talent acquisition thing. So we all on this call deeply care about how do we invest more in nature and climate, and that's coming through in the organizations that we're choosing to work for. So it's not just a business imperative now in terms of doing this because we need to be net zero. There's going to be an obligation. It's actually more than that now, which is really push for this, and it's to do with the next generation of talent coming through the business.
Brilliant. Yeah, thank you, Luke. So very quickly, two more questions. One is in the chat and it's easy to answer. Glenn asks if the UK is considering accepting PIUs or only verified units. I can answer that. It's only going to be verified units. People have made the argument for PIUs. They are not going for it. So I'm afraid it's just verified ex post units. But very quickly, one final question, which I think we should answer. Data related to offtakes is based on public disclosures. The biggest buyers are currently energy companies that tend not to publicize their deals. Therefore, how can we affirm that Microsoft is the only/biggest forward buyer and how to overcome this bias? That's a great question. Luke, I know you've been working with Allied Offsets who have a wealth of data on this. Do you have anything, or maybe that's a question we take away for a more considered answer?
I think, yeah, I mean, I would say the majority of there's been significant increase in the number of buyers. What we are seeing is big commodities trading firms are now entering into the market at quite a large scale, and it tends to be off register and in forward contracts and forward offtakes. You don't need to publicize that. I think Microsoft has statistically been the biggest procurer of CDR. I mean, Allied Offsets, I think, says 46% of the market, so a significant amount. And that comes from conversations with the buyers, what's going on, conversations with the organizations that are conducting those offtakes, because by and large, there's an intermediary normally or a project proponent in the middle there. However, I agree, that there is bias towards Microsoft and the hyperscalers. So it will be interesting to see how this shakes out in the next current years. But I think, as you say, energy companies, but also I would say commodities trading houses are increasingly, like the likes of Glencore, Trafigura, etc., are increasingly entering this market at scale, and they have a slightly different risk threshold to energy companies and the like.
Mm. Yeah, brilliant. And I believe Allied Offsets just published a report on likely future buyers, which we can circulate along with other publications from different organizations after this webinar. Brilliant. I think we've, oh, sorry, Stephen.
I just want to add one thing. I think it's quite, this is where I was kind of relating to in my slide deck about green hushing, is that organizations feel scared about being able to talk about and communicate what they have done. And I think that is something that we need to try to change and shift. So yes, Microsoft and others might be the ones that are making a large song or dance about it. But I suspect there are plenty of other organizations who are doing not quite maybe at that scale, but doing the right things, but not necessarily talking about it at fear of reprisals or being challenged about it. And I think we need to recognize that organizations should have a, I don't want to use the word safe space, but some form of ability to be able to communicate what they're doing without having everyone start slamming into them. I think it's important that we support each other and learn from each other, which I guess is the reason why, Phoebe, you're doing this piece of work.
Yeah, exactly. Fantastic. I think that's a brilliant point to end on. So I think it's just with me to thank Stephen and Luke and all of you for your contributions. Fantastic presentations from Arup and Nature Broking. We will circulate the slides to everyone and a copy of the recording, along with links to relevant resources and, of course, the survey and the we can issue a short brief that basically summarizes what we're hoping to do with corporates. So those on the call that are corporates, or maybe you're an intermediary slash supplier, really happy to pick up offline on how we can work collaboratively to get together to really get to the bottom of that question that we posed earlier. So yes, thank you everyone. We're hoping to conclude this program of work in July, and so we'll have our learnings to share with the market, but also with government as they continue to push on their carbon policy development. So we really hope that everyone's felt this has been a good use of their time, learned a lot, shared a lot of learnings, and asked lots of great questions. So thank you again, and hope everyone has a great day.
Thank you very much, everyone. It's been a pleasure to talk to you, and yeah, any questions, reach out. Thank you.
Thanks all.
Bye bye.